as recently as 6 months, a year ago, people were saying, "Hey, inflation is really hot. Why aren't gold and silver going up?" And I said, "Well, they already went up to account for inflation. That's what happened in 19 and 2020." And the metals tend to look around the corner. And so what I think the metals are doing right now, technically, you can see it in the charts. What I think the metals are doing right now is they are sniffing out the ultimate Fed pivot.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. As we continue our coverage of the gold and silver space, which has seen no shortage of exciting events recently. We're recording on Tuesday, December 13th, where gold and silver prices up quite a bit a day ahead of the Fed's announcement, which will be coming out on Wednesday. And interesting to see CPI comes in just a tick or two below expectations, and people are out there buying everything. So fortunately, to dig into all of these events and the pricing, I'm joined by Lawrence Lepard of Equity Management Associates. So Lawrence, great to have you here today and try and make some sense out of everything
Yeah,
that's going on. And how's everything going with you?
everything's great, Chris. Good to be with you. Thanks for having me on your show.
Well, appreciate you making some time. And certainly, as we've seen quite a rally in gold and silver in these last couple of months of 2022, perhaps we can start there. Are you surprised that even with the Fed still hiking, that we've gotten quite a ways from the lows in both gold and silver? And are you surprised at how much it's moved, given where we still are? Or why don't we start
No,
there?
I'm really not, and I'm kind of encouraged by it. I mean, we never knew when the move was going to come, but people always say, "Why are things happening?" And in markets, and as recently as 6 months, a year ago, people were saying, "Hey, inflation is really hot. Why aren't gold and silver going up?" And I said, "Well, they already went up to account for inflation. That's what happened in 19 and 2020." The metals tend to look around the corner. And so what I think the metals are doing right now, technically, you can see it in the charts. What I think the metals are doing right now is they are sniffing out the ultimate Fed pivot, which won't be a hard pivot unless things really break, but it'll start off as being a soft pivot, or the rate hikes will slow down, and we already see that. Maybe they'll do 50 tomorrow. We don't know, and then they will stop, and then of course, as things start to break, they will eventually go the other way. And I think ultimately they'll abandon QT and so on and so forth, because as we all know, you can't really taper a Ponzi. So, and to me, what's going on is the metals are smelling it, and that's why I think they hit their bottom for this cycle, and I think they're going up. Now, I could be wrong. There could be something that surprises me or us, and we have one more dip down to the lower levels of 3 or 4 months ago. But it feels to me like we put in a bottom that's going to last. It took 2 years to do it from the high in the 2020 range. So, it's a pretty big correction, and they've come down significantly. And of course, it's a higher low than the last time around. And of course, as I've said in other podcasts, I mean, this is a big one, because when gold gets through the 2070 area, when silver gets definitively through the $30 area, they'll be, in the gold case, not in the silver case, but in the gold case, it'll be at a new all-time high, and the silver case will be headed back to that $50 high, and that would be a breakout. And so I think we'll really get some momentum going there.
Yeah, it's certainly going to be interesting to see what happens when silver gets over 30. We've seen it touch right underneath that mark a couple of times in the last few years, and I continue to wonder many days if that's a bit of the line in the sand there. Although something else you mentioned in terms of seeing the markets break, I mean, we're watching some historic interest rate hikes that
Oh yeah.
we haven't seen this pace before. Now, throughout that, we've seen trouble with the yen. We've seen trouble with the gilt market.
Yep.
We see banks teetering like Credit Suisse and people withdrawing their money. Are you surprised that we haven't, I don't want to say that we haven't seen a breakage in the markets, because obviously real estate, stocks, bonds, all down quite a bit, but not something quite like 2008 just yet. Are you expecting that, and surprised we haven't seen something like that already?
That's a great question, Chris. Yeah, I'm a little surprised. I thought things might break a little more severely, a little more quickly, but they haven't. There's a lot of free money out there. It's still sloshing around. But yeah, remember, this has been the worst year in bonds in, I don't know, 30, 40 years or more. it's been a pretty bad year in stocks. It's very rare that both of those go down. Generally, if stocks go down, bonds go up, and vice versa. So, and we have seen cracks. I mean, the gilt market was a really big clue, in my opinion. The blowout in the Spanish or in the Italian yields was another one. More recently, some recent cracks. We saw Blackstone gating their real estate fund, and then Starwood followed suit. We're starting to see things break. I mean, the Fed's remittance to the U.S. Treasury has gone deeply negative because they're paying out a lot of interest to hold the RRP money in place, and in turn, they're not getting as much interest income from their bond portfolio. So we're seeing cracks, and obviously the housing market has gone completely dead. I mean, mortgage interest rates are up probably the most in history, bouncing around 7% for a 30-year now. It used to be 3%. We've seen the new car new car sales, and car sales are down substantially. I think they were down 25% month on month. That's one of the biggest ever. So, I like this phrase that Mohammed El-Arian said. He said, the Fed slammed on the brakes and the economy is in the process of going through the windshield, and but the process takes some time. And I compare it, it reminds me a lot of the 2007 and 8 timeframe when we all knew there was a housing bubble, or many of us did, not everybody, but a lot of us did. You kind of see it. And in the summer of 2007, 2 of the Bear Stearns funds blew up that were dealing in the real estate stuff. And that was like the early warning sign. And of course, Lehman didn't go bankrupt until September, October of 2008. So what is that, 15 months later?
Right.
And the Fed started this rate hike cycle in February of this year, and they got really aggressive about it over the summer and the fall. So it takes some time for those things to flow in and through the economy. But I think the flow is taking place. And, if you kind of assume the similar amount of time from, the change in conditions to it really becomes critical, a year to 18 months seems realistic to me. So that would imply I foresee that we're going to really things are going to start to break, and the Fed might have to pivot quite aggressively in Q1 or Q2 of next year, as all the economic numbers start to go in the wrong direction. So that's kind of how I see it unfolding. I could be wrong. Could take longer. Could happen short. I mean, it could happen tomorrow. I mean, we don't really know. We obviously saw the crypto blow up and FTX. I mean, another good example of liquidity affecting speculative areas. I read this morning that venture capital, there's a site called Forge. I read it in Barron's, that a site called Forge that keeps track of venture capital pricing. And they make a secondary market in private equities that are done by venture capitalists. And the average discount off of the last round valuation for the secondary market on venture capital deals right now is about 50%. So that means that all these unicorns that were getting, valuations of $1 billion a year and a half ago, if you want to sell your stock in that, you're going to get a 50% haircut. And I think that'll get worse. So what we're seeing is, the process of the monetary tide going out. And obviously the Fed had to do this for political reasons because inflation was, scorching hot. And, they'll get some decent inflation news. They'll redefine the target upward. Suddenly unemployment and the health of the economy will become a bigger issue, and we'll be back at the printing press pretty quickly. Importantly, also, I think, Chris, is to look at the, the budget deficit. And Luke Rome has done a nice job of pointing this out. I mean, the TBAC, the Treasury report that comes out every quarter, talked about how the government is now projecting they're going to run a deficit of about $1.3 trillion in the first 6 months of this coming year. Right? And I actually tweeted this yesterday. I mean, last year's deficit was $1.4 trillion as recorded, but in fact, the debt level went up like $2.2 trillion. So, the government debts and increasing government debts, and if we have a recession, right? I mean, in fact, the November numbers just came out on tax receipts. I tweeted this last night. The Wall Street Journal had it. And tax receipts were down, I think 10%, and expenses were up about 6%. So, if the economy is rolling over, as I think it is, government finances are going to get worse, which means they're going to have to sell more bonds, et cetera, et cetera. So there are a lot of things. I mean, what I would say are cracks in the system starting to emerge, but there hasn't been a Lehman moment, with the exception maybe of England. Like Lehman, England did have a Lehman moment. And that to me is a preview of coming attractions, that others will have a similar moment. And for those who don't know, I mean, what happened over there is they they announced tax cuts, and they announced spending increases to cover electrical bills. And the pound started to fall very quickly, and the gilt rates started to go up very quickly. And then basically the pension funds that had used something called liquidity driven investing or liability driven investing had levered themselves up. They couldn't handle the higher rates, and they were close to going bankrupt if the government didn't bail them out. Of course, the government bailed them out. So the point is that everybody, absolutely everybody in this economy is out over their skis in terms of free money, and the money's not free anymore. And so and I totally understand why the Fed had to do what they had to do. And they're going to push this as far as they can, and then when this campaign is over and things are unemployment and the downturn become the bigger issue, even if inflation is somewhat hot, they'll have to go back to printing because they don't want to have a collapse. That's kind of how I see it.
Yeah, it certainly is quite a corner that they're backed into, and not really any easy exit there. Although something you mentioned there in the gilt market, and I'll pull that chart back up, we saw the yields rise pretty quickly up to about 4.5%, and then the government stepped in. Are you surprised with the degree to which the yield has come back in? Today we're at 3.27. And do you think that we've seen the end of that situation there?
Yeah, I'm not a bond market expert, and I can't really say. I mean, they came back in a lot, and that's in part front running. They thought the government was going to support them. I mean, the U.S. 10-year was over 4, and it's come back in. I don't have it right in front of me today, but it's I think it's in the mid threes. And I think what the longer bonds are starting to discount is that in fact the economy is going to slow down and inflation is going to slow down. Yeah, say 3.465, and it was up over 4 earlier this year. And so I think the bond market is actually now telling us that an economic slowdown is coming, and maybe it's even believing that inflation is going to be somewhat subdued and under control. As you mentioned in the lead into the show, we got a soft inflation report today, not terribly soft, but slightly soft. And look, if the economy does slow down, there will be less demand for things. Although it's tricky because China's opening back up again, and that will create a lot of demand for oil. And I looked at a copper chart recently, and copper is looking pretty healthy. So on a chart basis, so there are a lot of moving pieces. I mean, I think the bottom line is that we are in a new inflationary environment, and inflation will wax and wane, but we're never, in my opinion, we're never going back to 2%, 0 to 2%. That's just not happening. I mean, you look at, yesterday, I retweeted this as well. The, airline pilots just got, basically an enormous pay increase through their union, something like over 10% a year, and in some cases as much as 20% a year, because there's a pilot shortage out there. And we saw the rail strike, and of course the government had to step in to solve that. But the labor costs are growing very consistently at north of 5%, maybe approaching 6 or 7. And so with labor going up at 6 or 7%, how do you get to a 2% inflation rate? I can't see it. So I mean, my view is what's going to happen here is the government's going to be forced to accept that inflation between 2 and 6% is kind of tolerable, and that they'll and so there'll be times when there'll be more inflation hockey and trying to slow down the economy to kill demand and keep inflation under control. And there'll be other times when, if the economy is really tanking and unemployment's high and people are screaming about how jobs are being lost, they'll back off on the inflation front, and they'll try to they may pivot and print more money to try and keep things going. So it's kind of it's a shit show of I don't know, I call it kind of either economic whiplash, or these guys driving this clown car where they hit the deflationary guardrail, and too deflationary, oh my god, we got to print some money, and then they hit the inflation guard, oh shit, we got way too much inflation, we got to jack interest rates up. And it's I mean, what it shows is the folly of trying to set the cost of money as a result of government policy. I mean, this is, when I was a kid, the big joke was about the Russians and the Soviet Union, and they would set the price of grain, and if they set it wrong, they all starved, and if they set it too high, or too low, they had a grain surplus, or too high, they had a grain surplus. So you can't, the market is best at setting an interest rate. Interest rate's the price of money. It should be set by balancing the supply of money, which is savings, with the demand for money, which is the demand for investments. And of course, that's not what we've got. We've got we've got a Politburo, otherwise known as the Federal Reserve, setting the prices, and it's a mess. It's a complete mess. I mean, they have shown that they've got a great ability to mess it up. So,
Yeah, it's interesting you mentioned that, because I think there's a whole generation of people that have not ever lived through something even remotely resembling a free market. I mean, we're seeing White
yeah,
House dictate the oil market now, and
yeah,
again, as you mentioned, just imagine if the price of money was set by the market, and
what a concept.
perhaps not surprising that we're already hearing whispers of, oh, is 2% really the ideal inflation target, or if we can get it
Right.
down to 2%, maybe it should have been higher all along. Which,
Well, that's right. They'll look, they'll jam the numbers to fit the narrative. And yeah, I mean, you're right. This is not, I mean, look, even back when we were, teenagers, I mean, there were wage and price controls. The government's always messed around in the markets. That's nothing particularly new, but the level of messing around has gotten, enormously larger, ever since the Fed became more activist. I guess it started in '87 when they created the plunge protection team, and it's only grown larger year by year by year. I mean, they bailed out LTCM, they bailed out the banks in '08, they bailed out the world with COVID in 2020. I mean, they're trying to tighten the money supply, and they're trying to shrink the balance sheet, and they are shrinking it, not quickly, but they are steadily shrinking the balance sheet. And when something breaks, and I believe something will break, because you can't offer all the bonds that are being offered into the marketplace and find willing buyers at rates that are negative, where the real yield is negative. So that, my belief is that when something does break, they'll have to come back with more money than ever, and that suddenly, there's the balance sheet. So you can see it's coming down, not a lot, but it's coming down. But the last print was what, $4 trillion, something like that, maybe five is getting up towards that, and the next print could probably be 6, 7, 8, 9. I mean, the Fed balance sheet's going to 30 trillion, easily, in the next 5 years, in my opinion, because without that, we can't service our debts, and interest rates are going to go to the moon. I mean, another chart that it was widely circulated yesterday, I thought was an excellent chart. Sven Hendrick has it on his Twitter feed, was the chart of U.S. Government interest expense. I mean, it's a debt spiral, right? There's a vicious circle here, that as interest rates go up, the government, being one of the largest debtors with 31 trillion of debt, pays more and more in interest. I mean, we're up to $750 billion a year in interest costs. It's almost the size of the defense budget. 3 or 4 years ago, that number was in the 200-300 range. So, as we borrow more and we push interest rates higher as a result of asking for too much money and not enough, there's not enough supply to keep prices low, the problem gets worse and worse and worse. So a lot of us have identified this, and it's why I think ultimately, sound money, precious metals, in my belief too, Bitcoin are going to be very, very attractive investments in the next 5-year window, because these guys are mathematically trapped, as you alluded to.
yeah, it's quite a dynamic where you have the Fed tightening its interest rates, but also removing some of the quantitative easing balances. At the same time, we see China reducing their treasury holdings. We see Japan reducing their treasury holdings, and you have 3.5% yield, while inflation is still coming in at 7.5%, according to CPI, if one chooses to subscribe to that. And then on top of that, you mentioned we're going into a recession, tax receipts coming down. I know this is the unanswerable question, but when does that all matter? It seems like it keeps getting pushed out, but
yeah,
when do we reach that break point? And or perhaps, or even more importantly, let aside the timing, but what actually happens at some point when this just becomes too much?
well, I think this is where we kind of know what the trends are. We know what probably ought to happen. This is where I actually think technical analysis is pretty useful. Just looking at the charts, right? And so, I think that when oil starts to go up again, oil is kind of the master resource. It's nature's discount rate. When oil starts to go up again, when gold and silver take out the levels that we're talking about, the 30 on silver, the 2070-ish level on gold. When the bond market stops going, the long bond market stops going down. I mean, right now we're in kind of a deflationary impulse. But as you showed, I think the 10-year earlier, it looked like it was starting to curl up again. I think it's all going to matter. And it's hard to say, Chris. I mean, handicapping these things on a time basis is extremely difficult. But from my experience and having watched these things for 40 odd years, I kind of feel like it's going to definitely matter within a 2-year window. I mean, that's like, I'd be shocked if it takes more than 2 years for serious issues to emerge. And to be more granular about it, I actually think it's going to matter a lot in the next 6 months. I mean, I think gold and silver are going to take out those levels we talked about in Q1 of next year. And at that point, it's game on. And then I think and in turn, I think the bear market rally that we're seeing in the stock market will eventually fail. The stock market's living on hopium. I mean, they all think that we're going to have 7% earnings growth next year in the S&P. Really? I just don't see how that's possible. And we're trading at a fairly, elevated multiple of that. So, higher interest rates, slumping demand, a consumer that's very tapped out. I mean, we've all seen the savings charts. I mean, savings have gone down to zero. We've all seen the growth in credit cards. I mean, a lot of people right now are maintaining their lifestyle by putting things on their credit card, right? And that's not cheap anymore either. I mean, there was a time when your credit card interest rate might have been in the lower to middle teens. I mean, as I understand it, I never carry a balance, but as I understand it, most credit cards are now up in the 20 plus percent, annualized rate for people who are carrying a balance. So, this is all, it takes time for these trends to, manifest themselves, but they will. And I think the place, my dashboard, the things I watch, I watch the price of gold, I watch the price of silver, I watch the yield on the 10-year, and I watch the US stock market. And so I think the stock market will ultimately roll over. The yield on the US 10-year will start to go higher. Even though the economy is slowing down, people will realize, and even though inflation is theoretically coming down, people will realize it's not coming down enough to make, a 3.5% yield money good in terms of a real rate of return. And I think in turn, and I think gold and silver, as we're seeing right now, are beginning to smell the deficits and the monetary debasement that the Fed will be forced into. I mean, I think the thing that still kind of amazes me is that, the Fed is able to tell these lies, and people kind of, or tell lies, or I'm sure they think they're telling the truth, but, and people kind of buy it. I mean, they say inflation's transitory, people buy it, right? They say, we're going to be hawks, and, we're going to get inflation back down to 2%. People believe it. And, they're not going to get inflation back down to 2%. Even they probably know that. They're acting like they are until they can drive these things lower. And then, it's a political organization. And so the issue here really becomes, when is financial stability more important than inflation? And, right now, financial stability seems to be okay. So they can continue to be kind of hawkish. But I think that's going to change. I think they're going to have there's going to be a lot of squawking. And, like I say, I mean, you see it. The thing that's very interesting to me is that people are starting to look for the exits. I mean, this gating of the Blackstone real estate fund, and that's a big deal in my opinion. And people who have their money in there, and it's private, you got to be wealthy to do it. They think they're getting 8% rates of return. Well, people at FTX thought they were getting 20% rates of return until they're not. And what happens when you go to take your money out? And that's really what this is. I mean, it's kind of a world. What Powell has created is kind of a worldwide margin call, and everybody's kind of saying, "Okay, well, what have I got? What's my money? Where is it? Is it really money good? Can I get it out if I need to get it out?" And I think what people are going to see is that, there's less money out there than they think, and in a tight money environment, we're headed towards a place where cash is king. Now, in my mind, there's some debate about how hawkish Powell remains for how long. And that's, we just don't know. I mean, tomorrow he could go 75. I mean, I think part of what they wanted to do was get the stock market down. They're probably looking at the stock market's reaction today and thinking, oh shit, that's not great.
Right.
So maybe they go 75 tomorrow to try and wake the market up. I don't know. I mean, they could go 25, who knows? But as you pointed out earlier, I think they will eventually, and you've seen guys floating trial balloons. I think they will eventually kind of come to the conclusion, 2%. Yeah, why were we there? Maybe we can live with 3 or 4 as long as your wages are going up. 3 or 4% inflation is not the worst thing in the world. And to be honest with you, that's what they almost have to do to get out of a debt trap. I mean, you can't, with when you're too indebted. I mean, that's what they did after World War II, right? And they had a huge debt after World War II, and it was called financial repression. They literally did yield curve control. They capped the interest rate on the U.S. bonds, and bondholders got screwed, but so be it. And they grew their way out of it. The GIs coming back, built houses and cars, and the economy grew, and they grew to the point where the debt level became much more realistic compared to the GDP. And that's what we need to have happen now. We need to, the way to get out of this without a complete collapse is to run high inflation. As much as painful as that is to run high inflation for a bunch of years, keep the economy going, let the GDP grow, and then the debt level relative to the GDP will go down. The difficulty is the fly in the ointment this time is back then they weren't running huge budget deficits.
Right.
And now we are. If we weren't running huge budget deficits, that inflate your way out of the debt would actually be, the inflation's painful, but it would be a strategy that would work. The problem is that in this environment right now, they've made too many promises and they're running huge budget deficits. And so it's very hard. As much as they continue to inflate, the deficit continues to grow too. So it's a mess. It's a real mess.
Yeah, and I guess the last question for you today, if you extend that out far enough, you mentioned the key difference between now and 1980. You didn't have such big debt loads, such big currency expansion. Do you think this is headed towards a reset? Is it possible to avoid that? Or is there some point where you have to do some sort of restructuring?
Yeah, that's a great question. And obviously none of us really know for sure. But it's headed to one of a bunch of outcomes. It's possibly headed to, a depression, but I kind of doubt that. I think that at the end of the day, all government actors will view high inflation as preferable to a complete financial collapse and a depression like the 30s. And so I think the question really becomes, where on the inflation dial are we? Are we going to have, like an Argentina-like inflation, a Venezuela-like inflation, a complete collapse? Something lesser than both of those. I mean, who knows? They're going to try and skate by, with high inflation until they get the debt under control. What they should do is they should do a structured monetary reset, where they, confess what they've done is wrong, and then, create a new currency backed by a sound money alternative. But that's, politicians aren't smart enough or forward-looking enough to do that. So my guess is what they will do is they will try to tolerate a little bit of inflation. A little bit of inflation will become a lot of inflation, and then a lot of inflation might ultimately lead to kind of a catastrophe, an almost a close to hyperinflationary like event, or a very high inflation event that kind of resets things. Everyone says, well, they're going to push the CBDC down our throats. I don't think they're ready. And to be honest with you, I don't think, most of the people in the system, I don't think they're smart enough to really understand all these issues. So I think what's going to just happen is these issues are going to unfold, and we're going to see how a democracy handles them. And my sense is a democracy is going to always vote, to spend more money, print more money, dilute the money. And so that's why people listening to this, myself, you, others, are so firm about, you've got to have money that the government doesn't control, because it's almost a lock certain guarantee that the government's going to screw up the money. And I think what most people are missing is that they've kind of done this in the past, but never to the degree they're doing it now. I mean, they did it in the 70s when they went off the gold standard. Gold went from 35 to 800, but Volcker was able to come in with a high interest rate and bring things under control. But remember, back then, debt was 30% of, government debt was 30% of GDP. Right now, debt is 130% of government GDP. Can't do that anymore. It's not going to work. So with that as a backdrop, they've literally just got to print, and as I'm sure you know it, and many of your listeners probably know, but Gresham's law is the rule that says, hyperinflations occur, right, when people realize that it is absolute certain government policy that they can never stop printing and increasing the money supply. When a quorum of the country realizes that, then something called Gresham's law kicks in, which says that bad money chases out good, which is to say people spend the bad money because they know it's losing value. The minute they get it, they spend it. In Weimar, they reset the prices every day. People get their salary, they'd immediately go spend it because they knew it was going to be worth less the next day. And in turn, good money gets hoarded because everyone knows the good money will hold its value. Gold and silver are good money. Bitcoin is good money, in my opinion. So, what's going to happen is that as a bigger and bigger piece of the population, I mean, those of us who are gold and silver bugs right now, we may see this as obvious and we know it and we believe it, et cetera. We're a very small part of the population. Right. I mean, the most of the people I interact with, they think I'm nuts. and most have they know there's an inflation problem. Don't get me wrong. Everyone's bitching about the inflation problem. They don't really understand what's causing it, and they don't necessarily understand the solution. Some do. I mean, more than 5 years ago do, but still, it's not a quorum of the country that sees it and sees that it's inevitable. Once it becomes obvious and then it becomes inevitable, it's going to be, it will spread, and it will spread quickly. And that's why, I think that once gold gets through 2,000, I mean, it could squirt up to 3,000 quickly. Once silver gets through $50, it could go to $100 quickly. And at that point in time, you're going to see a mania. And if the government keeps taking actions the way they've been taking actions, and they're unable to control their spending and to maintain high interest rates, eventually enough people will have lost faith in the dollar that literally everybody will be, the minute they get paid in dollars, they'll be using it to buy gold or silver or Bitcoin. And, and the dollar will fail, and the euro will fail, and everything will fail because people will realize I'm going to be impoverished if I have bonds, dollar denominated bonds, I'm going to be impoverished. They will not be worth what, they'll be worth the face amount, but, who cares? I mean, if gasoline's $100 a gallon, at the face amount of your bond, you've just lost 90% of your purchasing power because of the inflation that's taking place. So that's kind of how I see it unfolding. But I think, that kind of the Gresham stuff kicking in, I feel like that's probably 5 years away, maybe a tad more. I'm not sure. But I before you get to, and if you study the hyperinflations, before they got to just where it all collapsed, where everybody realized it was doomed, the currency was doomed. You look at Zimbabwe, you look at Venezuela, you look at Weimar, you look at many of them. Before that happens, you get a period of very high inflation. And so we've, peak inflation this time, I think peaked around what, 8-9%. I mean, the next, and we're kind of in a slightly down wave. We went down just a tad, right? Okay. The next up wave, my gut is, we're going to see 12, 13, 14, 15, right? And it's like, oh shit, we don't have this inflation thing under control at all. And then let's say you saw a 12% inflation print and you're holding a US government bond yielding 4%, you're going to say to yourself, fuck, this is ridiculous. I can't, I got to sell this thing. I mean, who's going to buy that bond, right? And then the government's going to say, all right, we can't let these rates go up, because if our interest costs went up to 12% times 31 million, holy shit, we'd have a $4 billion, we'd be owing $4 trillion in interest every year, and we can't afford that. I mean, you can see the death spiral that you're in, right? And so they're going to come in and say, well, we got to buy the bonds to hold the interest rate down because there's no demand for these bonds. Fine, they're going to buy the bonds. How are they going to do that? They're going to print money to buy the bonds. You see where I'm going here? I mean, this is all a circular problem that, it matches Hemingway's great description of how he went bankrupt slowly and then all at once, right? I mean, what will happen is we'll have higher inflation and higher inflation and higher inflation. And then eventually, just be out of control, and everyone goes, shit, this money's worthless. I'm out of here. And that's Gresham's law. And, look, and it hasn't happened yet. And it's hard to predict, and I could be wrong. And everyone says, oh yeah, you've been saying that for 20 years. And that's right, I have, and I've been wrong. That doesn't mean I'm always going to be wrong. And I'm sure there are people saying this in Venezuela, Zimbabwe, other places, Weimar, and if you're early, you're wrong. But if you can kind of see where the trend is going, and as I say, there'll be telltale signs. I mean, gold going through 2070, silver through $30, in my opinion, game on, game on, right? We're now at all-time highs. And that means, not a quorum, but that means a significant piece of the population has said, all right, I get it. My money's being diluted. I want some money that can't be diluted. You can't print gold, you can't print silver, right? And so it's, in my opinion, Chris, it's coming. It's coming, and that'll happen maybe next year, and then that'll lead to much higher inflation and a lot of other things. And eventually it'll be very clear, and the rush will be quite large because there's, as I said, this is another call and other podcasts as well. Consider that there's about $450 trillion of financial stuff in the world. And by that, I mean bonds, cash, stocks, CDs, all the things that you would consider to be, financial, money, or could be turned into money, 450 trillion. Total tradable, total gold market is maybe 10 trillion, but half of that's not tradable. It's either on women's necks or it's in museums, or, it's owned by central banks. About half of it's tradable. So call it, say, $4 trillion of tradable gold, less than $1 trillion of tradable silver. There's no stockpile of silver, right? As you got a nice picture of silver behind you there. And $300 billion of Bitcoin, almost nothing, rounding error. So, when that 450 says to themselves, hey, you know what? This stuff isn't holding its value. I need to get some money that will hold its value, that the government can't mess up. That 450 is going to come chasing the 4 or 5 that, represents sound money. I mean, think about it. We don't need the whole 450 to come after us for our stuff to go up. All we need, I mean, even if only 10% of it came after us, that'd be $40 trillion chasing a $5 trillion market. I mean, that's 8x, an 8x appreciation in the price of the sound money thing. So the point is, at the margin, I'm highly confident we are in the right stuff. And I think we just have to kind of sit back and watch it unfold, and it will unfold in our favor. But boy, it's been a long time coming, and it's been slow. And anybody who's in it for a quick buck, has probably given up on it by now. But I've been at this, since the 80s, and I've been really bullish on gold and silver since 2000 and 2008. And it feels to me like it's definitely coming. I don't see anything. I mean, what would worry me? Some of my investors, sometimes they ask me and say, "Hey, what would cause you to think your thesis is wrong?" That you're. All right, here's where my thesis is wrong. The government really decides to get disciplined. You know what I mean? They really decide to trim Social Security.
I think we're safe there.
Well, that's right. I mean, and of course they always laugh when I say that, but maybe they're not. I mean, maybe they're not. Maybe we're not. I mean, if the U.S. federal government really got significant financial discipline, that would change the trajectory of what I'm talking about. And I don't think that's impossible, but I don't rate it as the most likely case, given the political system that we live in. And I think most people listening would probably agree with that, right? So.
Yeah, I think it's unfortunate that we almost giggle when we think about the government getting fiscal restraint. Yet, you said you've been looking at this since the 80s, and we've seen which way things go, and it unfortunately doesn't look like we're headed in a much better direction now. And I think you nailed it earlier when you said there's a large portion of the mainstream that's still looking at the Fed and assuming they're going to be able to maneuver this thing down the racetrack, which maybe it'll take when inflation is at 12% to have more people question that. But either case, Lawrence, I sure appreciate everything you shared there. You laid things out quite clearly for people, and perhaps not the ideal dynamic that we're
No, it's not. Look, this isn't what any of us want to be going through and want to live through at this time in our lives. I know for me anyway, I'm 65. I'd like to be comfortably retired, not worrying about money, and not worried about what's going on in the society and our system. But it is what it is. I mean, these are the cards we've dealt, and we're dealt, and we got to figure out how to best play them. And I do think that, on the other side of this financial reset, which will occur when the money fails, as I kind of predict it will, that there will be a much better world, and we will restart. If we get back to a sound money basis, a lot of the ills of our society, in my opinion, will be much easier to deal with. And we will live in it'll be better for our kids and our grandkids, which is, kind of part of why I'm in the whole fight on this thing, because I think we can't leave them this broken system that's been created here and gotten worse and worse over the last 20 years.
Yeah, I think that is the positive to look forward to, and hopefully we do return to something like that and leave a little bit of a better system going forward, which unfortunately it took all this to perhaps
Yeah,
get there one
exactly.
day.
Well,
But
it is what it is, right? You can't, all we can individually do is make our own best decisions and decide what we're going to support. And I'm a strong believer in supporting sound money, and I think people who support sound money will be financially rewarded for it, but I also think that they can feel good about doing the right thing in terms of improving society. So there's a twofer there, right?
well, I hear you. And Lawrence, before we wrap up, could you just let folks know where the best place is to find
Oh,
you
thanks. Yeah, Chris.
and
So
what you're
two
doing?
things. As you know, I'm a loudmouth on Twitter. So I do a lot of shit posting. Yeah, at Lawrence Lepard, and not the fake me. I'll never DM you asking you how your trade is going. And sadly, I wish they'd get these blue check mark things sorted out because I get so many people who are imitating me, but I'm a loudmouth on Twitter. And then I also run a fund that invests in gold and silver and Bitcoin. And that fund can be found at EMA2. Yeah, Equity Management. The ticker, the URL for this is EMA, Edward Mark Alpha, the number 2.com. And there's a lot on there. I put my quarterly letters on there. We have a lot of research. It's all free. You can sign up for an email. We send out things when we get them. We'll never spam you. And people should feel free to reach out via either email or Twitter. And I'm as responsive as I can be. I can't answer every inquiry, but I try to be responsive if people have questions and stuff.
Well, I sure appreciate what you're doing out there, and
Oh,
not
thanks,
only
Chris.
running your fund, but also,
Likewise, I follow your site. I follow your work. I like what you guys are doing as well. So we're all in the same battle here.
well, just trying to shine some light on what's going on. And we'll have the links to your Twitter and to the fund in the description field below. And just keep on doing what you're doing, and we'll see how things unfold. And we'll look forward to doing this again soon.
Happy to do whatever you like. Thanks a lot for the venue. Take care.
Well, thank you to Lawrence for everything he shared there. And certainly, as I was talking with him, interesting. Anytime I hear about someone who's been studying this since the 80s, or some people even before, and seeing some of these things unfold in what often seems like slow motion. My entrance into gold and silver was in 2009, and certainly been an eventful 13 years for me. But anyway, great to get Lawrence's wide body of knowledge and insight into everything that he is seeing going on there. So do hope you found that one helpful at home. And before we wrap up, I would like to thank Blackrock Silver, who brought us today's show. And as I mentioned last week when we had Andrew Pollard on the show, Blackrock, which has primarily been exploring its Tonopah West project in Nevada, also did come back with a nice intercept at their Silver Cloud project, which is also in Nevada. And they had one drill result come back with 52.62 grams per ton gold and 606 grams per ton silver over 1.5 meters in a new high grade vein, which they have named Zeus, which I personally think is kind of cool. And fortunately, as I mentioned, we did catch up with Andrew Pollard of Blackrock, who was quite happy with the results and recorded a segment on the show last week. And to find out a little bit more about what they're doing at Silver Cloud, as well as a recap of what they've done throughout the year at Tonopah West, well, that video is coming your way now.